What are we looking at today?
So today we're somewhere between 5.25 and 5.5. We do have an arm that.
So what's an arm? Hey, Brian, how are you?
I'm doing really well. Robert, how are you doing?
Doing well. Thanks so much. So we're going to talk about the hot topic that's been on top of people's mind lately, the mortgage interest rates. I think we've all been used to the low interest rates for the past, 5 years now. We're looking at mortgage interest rates in the 5s and maybe 6s later on in the year.
Yeah.
Because
we've come down a little bit here in the last week or so, but historically, if you look in the last 30, 40 years, we're still on the low end of the spectrum as far as interest rates.
Exactly. So what are we looking at today?
So today we're somewhere between 5.25 and 5.5. We do have an arm that we've been touting with Capital City Home Loans. Either have a 10-year arm or a 7-year arm, and the 10-year starts at 4.25. The 7-year starts at 4 1/8, all the way up to $5 million. Covers primary, investment, second homes. There are some hits for the investment property. It's only 1/8 of a point higher for the second home. Still a fantastic product. It's like I said, 10 and 7-year arm. They do when they get into the adjustable rate portion of it, they adjust every 6 months.
So can you explain, because a lot of people that watch this aren't used to ARMs. ARMs were popular back in early in the decade, in the 2010s, and haven't been really popular since the mortgage rates went down. So what's an ARM?
ARM stands for adjustable rate mortgage.
Mm-hmm.
Now, granted, in 2000s and late 90s, there were a number of them that were interest only, and people were doing that, taking the interest only, got burned in them in 2008, which kind of led to the crash and all that kind of stuff. The ones that we have now, they are not interest only. So you're paying down principal and interest at the same time. They're for a 7-year term, 10-year term. Previously, they were called a 10-1 arm or a 7-1 arm or even a 5 or a 3-year arm. The 1 stands for every year they would adjust, or they could adjust once the initial period was over. These today are now called 10 and 10-6. So that means that every 6 months it can adjust. There is a cap as to how much it can go up, but more than likely won't ever hit that. And most homeowners do not keep their mortgage for more than 10 years. So for most buyers, it's a great option. It's a really, really great option for investment properties and second homes, especially the investment property. You get in a low rate, you got somebody paying down your equity for you. 10 years, if you hold it for 10 years, you can always refinance out if the rates drop again. 10 years down the road, if the rates are better or worse, you might be in a better position with that arm still.
So as you said, these aren't interest only, so you don't have a big balloon payment at the end of the maturity. So that it's just like a regular mortgage or loan. You pay the interest, you pay the principal, and what happens after, like for example, a 7-year arm? What happens after 7 years?
So year 7, there's an index that we use. So year 7, you can reach the cap in that first adjustment period. So it's 5% is the most that can go up. So if you start at 4%, you could only go up to 9% at that point. Now, granted, the economy's got to be really bad and the interest rate's going to be really bad to get to that. So it can adjust that full amount in the first time that it adjusts after year 7. More than likely it won't. And then every 6 months it can adjust again. After that, it can go down or it can go up. So.
And what is the ARM based on?
Typically, they're based on like the LIBOR average or those kind of things, and it's similar to that. So we have a scoring index that we use in house that determines our rate on that.
Now, does each lender have their own index, or how does that work?
No, so like the LIBOR average, I believe, is like the London index, whatever. Right. That's pretty standard for most lenders, and ours is sort of based off of that.
So if somebody doesn't want to do an ARM, they want to do a regular mortgage or loan.
Okay.
How does that look for them?
if you're just talking about a primary purchase for somebody's residence, 30-year note right now, like we said, it was between 5.25% and 5.5%, somewhere in that neighborhood. If you wanted to pay points to get a lower rate, you certainly could. The higher you go, you can get a credit from the bank. So if you need help on a down payment, that's the way to go. In addition to, so I'll try to keep it to the rates for right now. We can hit all the down payment assistance and that kind of stuff later. 15-year rates are still pretty good. They're in the upper 4s right now. FHA, I believe they're right around 5% at this point. Obviously, all depending on your credit score, depending on the loan amount. There's a lot of things that go into that, but those are just some ballpark what the rates are today.
Is there a minimum credit score that an ARM requires?
So for our ARMs, we do require a 700 credit score.
700, okay.
And they require 12 months of reserves. Now, the reserves can be 401k, can be IRA, can be savings account, checking account, anything like that. So it's just 12 months of those payments. And you've got that. So most of the qualified buyers that are doing that, that's not an issue.
And this is you go by FICO score, right?
Well, when we pull, we do a hard pull, so it's a little bit different than the FICO. But we take the middle score of the 3 scores that we get, and that's the score that we use for financing.
Now, is the ARM is not FHA or conventional or anything like that? It's just
nope. So it follows the conventional guidelines, but that is our product from Capital City.
What about the regular conventional loan? What's the minimum score for that?
So minimum score for us on a conventional loan is 620. You can do, as far as down payment options, you can do either 5% down. That's just your standard conventional mortgage. You can do 3% down if you're a first-time home buyer through the Home Ready or Home Possible program. Those do have income limitations that affect the mortgage insurance. If you make above the amount, so it's going to affect it. Obviously, you can get to 20%. You have no mortgage insurance.
Right.
That's always what most people are trying to get to.
Let me ask you this, and I'll edit this out if you want. Has it become harder for people to come up with 20% with the prices going up so fast and homes getting more and more expensive?
I think where we're running into the issue is when there's appraisal gaps. So with the home prices rising, the appraisals aren't keeping up with what the market's showing. So there's been a tendency for there to be a gap. Well, not only do you have to have the down payment, you now have to have that gap to cover that difference in there. That's where we've been running into the issues with clients. As far as down payment, that has not been an issue. I think most people that have been saving their money or they have the equity coming from the sale of their house, that's not an issue. But really our biggest one is the gap between the appraisal and the value.
When it comes to FHA loan, can you ask for the buyer to cover the appraisal gap, come to the table with the appraisal gap?
Well, you're going to run into the issue with the seller concessions on that. So they're capped at a certain percentage. Which I'd have to dig through my notes. I believe it's 3%, could be 6%. I'd have to double check. But there's a cap on that. So if you got over the cap with the gap in there, you would run into some issues.
So if let's say my buyer has an FHA loan and they decide to contribute 10 or 15,000 towards appraisal gap, can they do that with an FHA loan?
Again, I think you're going to run into the issue of how much of the concession they're giving. So that would be that gap.
Yeah.
It's got to be underneath the FHA limit.
Gotcha. 3%.
Yeah, I think it's 3%. So because conventional, it depends on how much you put down.
Okay. Is that true? Also true for VA?
Well, VA, you can do 100% financing.
Right.
But if there's a gap in there, VA is a little bit more stringent on that than the FHA portion is. So that one, I've not run into that one yet.
Okay.
So I can't speak to it.
When do you think? How far do you think or how high do you think the rates will go?
I thought in perfect honesty, I thought they'd be in the 6s by the end of the year. We were almost there.
By the end of 2022?
By the end of 2022. I thought we would gradually get there. And then February and March happened and April, and they jumped up into the upper 5s. And so we've actually come down a little bit. We'll see. I think we're going to settle somewhere in here between 5 and 6 for a while. But again, it's just
because the Fed's still slated to raise the rates two more times.
So that interest rate doesn't really affect our residential mortgage rates.
Exactly.
That's based more on the 10-year Treasury notes. So,
Right.
I mean, that's affected really by where investors are taking their money, if they're putting it into bonds or if they're putting it into the stock market. So typically what you'll see is if the stock market is going down, the interest rates are going to be better because people are putting their money into the stock market now and the bond prices are going down. So it's
Absolutely. What does affect the home mortgage interest rates?
Well, there's about 26 things that affect it.
Okay. Let's do it.
I mean, I could try and list them all. Some of them are kind of duplicates.
Just do the top
the
five.
biggest one is going to be your credit score.
Okay.
That has the biggest impact on your interest rate. The size of your loan to value. So whether you're putting 5% down, 20% down, 30% down, that has an effect on it. Your debt to income ratio can affect it. So, I mean, those are the main ones that affect it.
But as far as the rates going up and down.
Oh, what affects that?
Yes.
Yeah, that's primarily based on the 10-year Treasury note.
Okay.
You can pretty much follow those, and you can see them as they work together.
When the 10-year Treasury goes up, the rates usually come down.
That's the opposite. It works the opposite. So when the 10-year note goes up, our rates go down,
somebody wants to buy a house now and obviously is looking at their interest rates and they're in the fives and I know you said they've come down. They have the ARM as an option.
Yes.
And as you said, most people don't live in their house for more than 7-10 years, especially first-time home buyers. That their life situation changes. They get married, they have kids.
Mm-hmm.
They're looking for a bigger home, or even older buyers that want to downsize after a while.
Correct.
So getting an ARM adjustable rate mortgage probably makes a lot more sense.
Yes.
For them.
Well, like I said, most people don't hold their mortgage for 10 years. Now they may stay in the same house, but like you said, all the life changes happen. I mean, weddings, people do a cash out refinance, or they move for a job transfer, that kind of stuff. So yes, that 10-year ARM is actually a really, really good product, especially when you're locking in at 4.25. That's still historically crazy low.
Hey, off topic, I have a question for you. Have you seen monthly mortgage payments go up tremendously lately?
Well, with the increased rates, yes.
Huh?
With the increased rates, yes.
But for example, if I lock in at 3% 2 years ago,
okay.
Obviously my rate's not going to change because I'm locked into a 20 or 30-year fixed. Do you see the especially where we live? Do you see the monthly payments go up?
So typically, what I always tell my clients is, you buy a house and you've got the tax bill from the previous owner, and it's good for that year or whatever. Well, once you buy the new house or buy the house, it now has a new assessed value.
Right.
So more than likely it's going to go up. So yes, their tax bill will probably go up the very next year. I think I just got my tax bill a day or so ago.
Yeah.
Yep. And I believe mine went up just a little bit. It wasn't something crazy. I know some other folks around in my neighborhood, when we were talking about it, theirs went up a little bit more substantially than mine did. But I mean, taxes are always going up. They never go down.
That's the truth. Well, I was just wondering, because, as I said, if you have a 20, 30-year fixed, obviously your rate's not going to go up, but something's affecting your escrow to make your payments go up.
Yes.
Right?
Yes. Your payment would be going up. So yeah, because you're locked in on principal and interest on that.
Correct.
For 30 years or however long it is. But yeah, those are the outside ones. Plus, I mean, your insurance bills could be going up. I've noticed insurance policies are now going up a little bit.
Have you?
So between insurance and taxes, yes, you're going to start paying more in addition to a higher rate now if you're purchasing. So that's starting to squeeze a little bit of the buyers, affecting what they can purchase. So like when we're talking about the people buying, especially now, because all these people have all this equity, well, they're afraid to sell their house until they find a house. So what they end up doing is end up buying, what we've been doing is say we get a Heloc to cover that. You've got the equity in your house. We'll take the Heloc, use that as your down payment. You turn right around once you buy, and then you sell your house, you pay off the Heloc. That is the cheapest way you can do it. And Capital City Bank Group, which we're part of, has a fantastic product on that. Introductory rate of like 2.99%. No closing costs if you leave it open for 3 years. It's so low cost for them. You'd make what, 1 or 2 payments before your house is sold, and you're good. We've done a number of those for some clients, and that's a great way to do it. Either that or they tap into like a 401k or retirement. It's a down payment.
So go back and explain how HELOC works.
So a HELOC, home equity line of credit, is what that stands for. So you've got, let's just say your home is worth $500,000 and you only owe $100,000.
So you have $400,000.
You got $400,000 of equity there. Well, you can tap into that equity, and you're going to pay interest only on that for a 10-year term, and it does have a balloon at 10 years that you then pay over the next 20. So you can tap into that equity and get your down payment to purchase a home or fix up your home or add a pool or whatever you want to do. And then you just, if you're smart, you just pay it over the next 10 years and you just pay it down with principal as you need to.
And typically, what are the payments for something like that? Just roundabout.
Ooh, wow, that could be dangerous. I want to say you're probably gonna be less than $200 if it's like a $150,000 loan. HELOC might be closer to $300 at that area. It's somewhere in that neighborhood. I really don't keep up with that too much. We do a first position HELOC with Capital City. So first position meaning you own your house clear and outright. Well, we're just going to do a HELOC for you because you're going to buy another property. You're going to do whatever you want to with it. We'll do the first position HELOC with it for you. We do offer that. So, there's no PMI if it's 80% or less, that kind of stuff.
So have you ever heard of people taking out HELOCs to put a down payment on their, not down payment, but down payment on their next home that they're buying?
Yes.
Okay.
Yeah, that's what we were just talking about.
Right.
So you tap into that equity, you'll use that HELOC funds for the down payment for the new purchase.
Before selling their current.
Before selling.
Oh,
yes.
Okay.
So the only thing is you just have to qualify with both your new house payment, your current house payment, and then the HELOC payment. Which.
Wow.
Yeah.
It's a lot of pieces.
It is a lot of pieces, but it works. It works a good portion of the time. I'll be honest.
Excellent.
So, or we do a combination of, you can, a lot of people, we recommend you can pull from your retirement, your 401k. Some of 401ks will cap you at $50,000. Just depends on what your plan is and the rules. They may charge you a couple $100 to do it as well, but you're basically borrowing against yourself, your own retirement. You use that for your down payment, and then you pay it off once you sell your house. We've been doing bank statement loans too.
Oh, okay.
So self-employed borrower, most self-employed borrowers like to write off a lot of their income legally. So they may not show a lot of income on their tax returns, which is not good for us because we like to see your income. But we do have bank statement programs. So we'll just go through your bank statements for 24 months and see what you're actually bringing in cash-wise. We'll use a percentage of that for your income, get you qualified, good to go that way. So self-employed borrower doesn't have, just because they write everything off, we know there's money coming through there, and we know that they're writing things off. They can still use the money that's coming in. We'll use it as a bank statement. Self-employed borrowers really need to have 2 years of income, documented income, so 2 years of tax returns. If you've only got one and you've made enough money in that first year, we can use the one. We just have to divide it over by 24 months. So we basically cut your income in half. So you got to have enough money to do it. You got to show enough funds. In fact, I'll give you a perfect example. I'm going to give you 2 examples here on the self-employed side. So the first one's going to be, he's actually a friend of mine. He's a self-employed person, owns his own company, basically wrote off everything, only been in business for a year. So they have one tax return. They made enough money in that 1 year of tax returns to qualify for an $800,000 purchase. And so we were able to say, this is what you need right here, and we were good to go. Second example, professional football player. We use the bank statement loan, or actually we use bank statement / assets as income. So this is like on our portfolio side. Professional athlete that most people would know if I said the person's name. The income is different the way they do that. So we had to basically say, okay, here's his assets coming in. We know what's coming into the bank statement. That is what we used. Those two together we used on our portfolio side to get this guy qualified. Nobody else could qualify this person. He had talked to a couple of the major lenders in the country. Yeah. Oh, yeah. Some of the major ones that sponsor golf tournaments and that kind of stuff have arenas named after him. Could not qualify him. We were able to qualify him and keep him in-house. And, so he's qualified. He's actually closing this week.
Nice.
Yes.
Hey, brother, you're awesome. Thank you so much.
Thank you.
For giving me your time and for explaining the interest loan stuff.
Yep.
And
absolutely. Happy to do it anytime you need it.
Absolutely.
So, all right, bud. Just let me know.
Talk to you soon.
All right, thanks. We'll see you.
Bye.
I will say beer tastes really good out of here.
Have you had beer out of there?
Heck yeah, I did when I won that. What'd you do with it?
That's awesome.